we're not going to have the kind of increases of oil and natural gas production that we've had in the past. It's going to be very hard to grow production, and that's the problem that the world is facing.
Please join us for our next live stream,
Sunday, March 27th
at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be
Sunday, March 27th,
9 p.m. Eastern. See you then.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Steve St Angelo, author of the very popular and insightful website SRSRocco Report, joins us today. Steve is the go-to guy when it comes to oil, energy, and precious metals. And he also has a YouTube channel with the same name as his website, SRSRocco Report. We're delighted to have Steve St Angelo with us. It's time to saddle up and silver up for Steve St Angelo. Steve, welcome back to SBTV. How are you doing?
Patrick, doing great. A lot of things to talk about, so I'm glad to be back.
Absolutely glad to have you back on. You're definitely the oil and energy go-to guy, so we're happy to have you, especially at this point in history. Steve, lots have been going on by way of energy and with what we're seeing, especially in the Ukraine. It's interesting that the last time we spoke, months ahead of the Ukraine crisis, you had mentioned how China was in a real energy crunch and how Europe was going to feel high prices as well. Now, with the war going on with Russia and Ukraine, have those two conditions between China's energy crunch and Europe's higher fuel prices changed, and how?
Yeah, I call it the energy cliff. The dynamics were going to continue to worsen over time, even though we could see high prices and the low prices, recession, and then surpluses for a little bit. But the pandemic sped the process up, and now the Ukraine war has sped it up even more, because of the geopolitics. So because a lot of energy is fungible, oil is transported all over the world. So high prices in Europe are going to be the same high prices in China or the same high prices in South America. That's just the way it is. So unfortunately, the Russian-Ukraine war has sped the process up more and has added a geopolitical aspect to this energy cliff dynamic that is making the energy prices very volatile. And we're seeing the volatility that's a very bad, a negative factor on a heavily leveraged global financial system. So this is, I said that the energy cliff, we would see more volatility. That's going to continue. And now when you add geopolitics, Patrick, it makes a bad situation worse.
Yes, Steve, the U.S. has set a policy of no Russia energy or no Russian energy allowed, basically. Now, with liquid natural gas or LNG, a major export of Russia, could you give us an idea of how much LNG essentially comes off the market, and can it be replaced, especially for those in Europe?
Well, first of all, most of the exports of natural gas of Russia, it's from pipelines. The U.S. sends a lot of natural gas in the form of LNG because it's not commercial to have a pipeline. But because Russia is right next to Europe, they have these long pipelines. There's a chart showing that the total LNG exports of the United States are a little less than 10 billion cubic feet a day. Well, Russia exported about 25 billion cubic feet a day of natural gas total. 75% of that goes to Europe. 75% of that natural gas. And some of it's LNG, most of it's pipeline. So now we're hearing a lot of politics on the West that we're going to shut down energy. We're not going to, the United States, Biden said, we're not going to import any oil from Russia. We see, and even the UK came out with that. Well, the UK and the United States has the very small percentage of energy imports from Russia. Germany and a lot of European countries have a very large, matter of fact, Germany imports 40% of its natural gas from Russia. So it's impossible. That's the reason why the German prime minister came out, even the economic minister said, we're not going to stop importing natural gas from Russia, even during the Ukraine war. because if they did, they would go into a depression in 2 or 3 months, because that's how important Russia's natural gas exports to Germany are, as well as Italy imports a lot of natural gas from Russia. So while while the UK and the United States can come out on the high road and suggest we're not going to take any energy from Russia, they don't have to. They don't import that much. The real problem comes with European countries who are very dependent on Russians' energy, not just oil, not just natural gas, oil as well as coal.
Yeah, that's a great point there, Steve, because I think, when it comes to something like NATO, which is kind of, sort of in the center of all of what's going on. I mean, one could understand, hey, let's all protect each other, make sure we're all safe. But the fact is, these are all individual sovereign countries with their own individual sovereign needs.
Yes, and I am against the war. I think Russia they really bit off more than they can chew in this campaign. But what the West is showing how awful the Russian military forces are doing in Ukraine. That's very inaccurate. Actually, from what I've seen, the military campaign, the military objectives that Russia are trying to accomplish, they're going right in line with their timeline. So there's a lot of wag the dog happening on both sides. But if we remove the war action, the problem is when we do all these sanctions on Russia, whether the U.S. or companies are no longer taking, like Shell and BP have pulled out of their partnership with Gazprom. I mean, that's good to do that if you feel patriotic and you're against the war, but that gun, it's got two barrels. One's pointing at Russia and one's curved back pointing at yourself. So by the European and West doing these sanctions, they're also shooting themselves in the face. And so it's not unilateral, it's bilateral. And so I just wanted to make sure the world realizes that Europe is going to suffer the most with these sanctions and these energy and high energy prices than the United States or Asia.
I know we kind of touched on this, but who holds the supply of natural gas? I mean, we talked about countries, but when it comes to global regions, who has it and which global regions don't?
Well, I put a chart together, and if we just look at the regions, we add up the whole region, all the countries in that region or the continent, their production minus their consumption, and we find out Europe is the weakest link. Their net imports are 31 billion cubic feet a day. And Asia Pacific, a lot of it's China, comes in South Korea, come in at second at 20 billion. They need net imports of 20 billion cubic feet a day. Now, what's interesting, Russia is the highest. Russia and the CIS countries, which are Kazakhstan, Uzbekistan, they have the most natural gas surpluses, which is about 24 billion cubic feet a day. The Middle East at 12, and North America, including the United States, about 8. And I think Africa is 7. So what's fascinating, Russia and the CIS states, they account for 47% of all the surplus natural gas that's being exported to the world. So you can't cut them. If you cut them from Europe, you have to get them from someplace else. So it's kind of it's a facade, so that there's no way to cut Russian natural gas production significantly. You can cut a little bit. You can't cut much, or you're going to impact your economy negatively.
Yeah, it's a great point, because looking at your chart, even if you look at North America and Africa, you're only looking at 15, where you see Europe already is negative 31, so it's not even covering half of what they need.
No, and you see that's the issue. You hear a lot of this the political stance of cutting off Russian, becoming Germany wants to become less dependent on Russia, and there's just no way, and that's why they had the Nord Stream 2, and so. The Nord Stream 2, Victoria Nuland, which was a U.S. official proudly announced the death of Nord Stream 2, which was a Russian pipeline to Germany, right next to the Nord Stream 1. And they would have got a lot more natural gas. And she proudly announced the death of the Nord Stream 2. Well, you see, it's no skin off of her or the U.S. because of the $20 billion that it took to produce that. Half of the money came from European countries. Half came from Gazprom. They lost all that money. And that would have been very inexpensive natural gas from Russia to go to Germany. Now they got to buy. They're gonna try to do LNG facilities. They're going to try to build two, and that's going to take 2-3 years. So all this kind of stuff that they're saying in the media it's really all BS. Because if you look at the chart, there's really no wiggle room. Russia is really providing about 40% of all the surplus natural gas in the world, and if you don't get it from Russia, then you're going to see your economy decline. And that's what it comes down to.
Yeah, completely agree with that. Steve, if you combine the stress on energy we're seeing right now with the running inflation that we're seeing right now, how much more will Europe and the US be paying for energy, especially coming from LNG?
Well, the US is paying less than $5 per million BTU of natural gas. $5, let's say $5, make it easy. Europe, it's over $30. $30, and the LNG going to Asia is even higher. It's $35, and so this is the problem. And what's interesting, the prices that Asia and Europe are paying have had spikes, but they're still quite elevated. It's still, Asia is spending 5 times more than what it normally pays, and Europe's paying 7 times more. Now, can this go higher? It can, especially if the Ukraine war escalates. If NATO and the United States and continue to send more military aid to Ukraine, there's more sanctions, then we can see even higher prices. I think when there is some kind of settlement to the war, the ending of the war, a peace or something, then the prices are going to fall. But unfortunately, Patrick, the problems with the energy cliff are going to come back to haunt us. And it doesn't stop. And that's the problem we're facing now. We're not going to have the kind of increases of oil and natural gas production that we've had in the past. It's going to be very hard to grow production with spending a lot of money, a lot of capital. And that's the problem that the world is facing.
Steve, before this current energy crisis happened, banks were talking of limiting their funding for fossil fuel projects in an effort to combat climate change. And seeing how fragile the energy supply and distribution can be, what do you think of these net zero emission policies? And are they even realistic? And where would the energy even come from?
Totally unrealistic, but that is what the media, that is what the companies, even the banks, HSBC just announced yesterday or a day before that they're going to finance less fossil fuels. Now, I want people to understand, I think fossil fuels is causing havoc in the global climate, but the green energy doesn't fix it. So I just want people to understand that. It doesn't fix the problem. And even the SEC, Gary Gensler, the SEC, they're coming out with this new thing now that it's called Scope 3 emissions. All publicly traded companies are going to have to start publishing their greenhouse gas emissions. And so the whole world what we're doing is we're adding green energy, which is pushing us to the energy cliff quicker, and then we're reducing we're reducing fossil fuel investment. So it's like it's a double whammy. And so the funny thing, the ironic thing, Patrick, is that these banks and these companies doing that, they're shooting themselves in their own face, in their own foot, because by curtailing fossil fuel production, you're going to negatively impact GDP, economic activity, finance, and all that. So there's green energy doesn't help the situation; it just makes it worse. So yes, the banks and the SEC they're getting aboard on this, and they're shooting themselves in the foot.
Okay, so with the fighting going on in the Ukraine, we have to understand that even war needs energy. And it's pretty strange to say that because this war is partially about energy. And we saw recent news about Saudi Arabia considering accepting yuan instead of the US dollar for oil sales. First, what are your thoughts on that? And then second, why do you think Saudi Arabia is doing this?
Good question. 2 points come to my mind. First of all, this is geopolitically motivated. And when I say geopolitically, it's self motivated. The Saudis are motivated because, when the Ukraine war started and the price of oil shot up, Biden tried to call up Saudi Arabia and some of the Middle Eastern leaders, and they wouldn't take his call. We saw this in the media. They wouldn't even pick up his call. Saudi Arabia said, "We will pick up your call. We will talk to you if you help us in Yemen." You see, right now, Biden in the U.S. In the White House is trying to get the deal, the nuclear deal, and lower the sanctions on Iran. Well, Saudi Arabia and Iran are not bosom buddies, and so the Iranians are helping the Yemenis war, which Saudi Arabia is involved in. And so it's a huge geopolitical thing. So because Saudi Arabia imports 25%, 25% of China's imports come from Saudi Arabia. So this is the reason why, part of the reason why they want to go to some of the oil to yuan. And I don't think this is a big deal. It will become a big deal in time. And the reason why it will become a big deal in time is because of the energy cliff and the world realizing that the United States is printing U.S. treasuries, not money, U.S. treasuries to fund its debt. And that's the problem that's going on. That's the reason, that's where we're getting the inflation, not from the money printing, but the treasury printing that the world is trying to absorb. So with those dynamics, I do believe we're going to see more countries try to move away from the dollar.
If you're enjoying this interview with Steve St Angelo from the SRSRocco Report and I, please consider subscribing to our YouTube channel and giving us a thumbs up to let the algos know you want more content like this. And if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Steve, we also saw oil go up to ballpark $150 per barrel, then go below $100 per barrel. But what happened with oil and this wild swing, this price drop?
Well, due to the war and all the geopolitics and the sanctions, and we're not going to take your oil, and Russia says, well, we're not going to send your oil. Well, actually, Putin says they're not going to stop sending oil and natural gas, because from what they're saying is that they do not want to impact the economy in the world. So they are free to continue sending it. But the problem is with different companies and countries putting limits or sanctions on the energy. We had the traders, so the price took off, and it gets so high, then you get a correction. And then there was some idea that there was going to be a peace talks or some kind of agreement, and that failed. I think we're going to see high prices again, and so this is just going to continue to be quite volatile until there is an ending of the war or some kind of peace agreement. And it's going to continue to be very volatile. But again, after this war is over, the world is still going to have to deal with the negative aspects of the energy cliff, and we're going to see much greater volatility going forward.
Yeah, okay. We'll touch on that energy cliff. And then because we also saw after oil dropping, the media came out and they said oil is in a bear market, and they were kind of cheerleading this thing along. Steve, if my grandmother were alive and she heard the media saying this, I think her false teeth would have come flying out on that one. It's just so unrealistic. But here we are again, oil back above 100. But why would they even say that? Try to give people the feeling that oil is moving into perhaps even a prolonged bear market.
This is I don't see that for two reasons, or three reasons, really. First, the idea that, maybe the idea the West is trying to push is Russia needs the oil. So if there's lower oil prices, Russia's going to get hurt. No, Russia produces oil pretty cheaply and a little bit more expensive than the Middle East, but a lot less expensive than the United States shale industry. So I think there was some politics behind that. And then we had the issue that we're going to have the green energy, right? We're going to have less demand from oil. We're going to have more electric cars, and all that. And that's so wrong on so many levels. We're not, because we can't add too much of the EVs to the grid, because the grid, which Europe is experiencing right now, they're paying 7 times the price of natural gas, which is a lot of it's used to generate power. So the electricity prices in Europe are going through. So if you want to charge a car, it costs a lot now, and that's just going to get worse. So these are the issues, and calling it a bear market, wait until the world's energy inventories continue to decline, and that's the SPR in the United States. Biden said we're going to release another 30 million. We released 50 million a month ago. Now we're going to do 30 million more. And as these energy inventories continue to decline, and we're not be able to grow them in the future or build them, this is not a bear market. This is going to be a bull market with a lot of volatility.
Yeah, I think that that strategic supply, I think that you're talking about, I've come across something where we're down to like 30 days or so. That's all that's left in it.
Yes, and what's even worse is the diesel. You see, while the world runs, the cars run on gasoline mostly, the trucks and the heating oil, which is the same distillate, runs on diesel. And we had last week, we had a 21% increase in U.S. diesel prices, and heating oil went up 21% in 1 week. So we have been, the U.S. was kind of out of the way. We were insulated from all the craziness happening, but it's hit finally in heating oil. And diesel is what the transportation, shipping, rail, and trucks are run on. And there seems to be issues now with diesel supplies. Diesel inventories are falling faster than gasoline and oil. And that's a problem, because when you refine a barrel of oil, you only get so much diesel. And so that is the problem. And so I think these are the issues that we're not really understanding. And they're, unfortunately, I keep saying this, they're just going to get worse. And I'm completely shocked at how the media is overlooking this and focusing on the war, which is bad enough, but it's really only a symptom of this energy cliff dynamic.
Yeah, I want to get to that energy cliff. It's something that you often talk about. Some people understand it, some people don't. But Steve, how does the energy cliff play a role when it comes to nations acquiring a required resource like energy, or even defense, or even just for the health and well-being of its population?
Well, when I showed you that natural gas chart, Europe is highly dependent on natural gas. They don't produce enough of it. Matter of fact, they have to import 31 billion cubic feet a day just to run everything. And so the U.S. actually produces a lot of natural gas. We produce so much right now, we export some of it. So we're kind of doing okay. And so when you look at the weakest links, you have to look at the areas, the countries, the regions that are importing the most. Europe imports the most natural gas. Asia imports the most oil. So it's kind of flipped, but both of them are the major importers of oil and natural gas. So I believe those economies are going to be hurt the most first. But as time goes on, this is going to move back. And I mentioned this. We've used debt. The world has added, I think, 150, the numbers I've seen by the IIF, International Institute of Finance. The world debt was 150 trillion in 2008 before the financial crisis. It's now 300 plus trillion. We've doubled the debt. Well, what the debt has done, it has brought on, and this is even before then, the debt has changed the oil production profile. We would have had kind of like a triangle or a peak, typical peak, and then decline. Well, now with the debt being added, we have brought forward production and we have increased the annual amount to 100 million barrels a day. Well, this is the problem we're facing because the debt has stolen energy from the future. And so now the decline is going to be much more dramatic. And that's another aspect the world doesn't understand. And when oil production starts to decline, it's going to be very hard to prop up the debt. And when debt starts to implode, then it becomes a self-reinforcing feedback loop. And so these are the dynamics that are taking place. And that's actually the reason why I'm a big supporter of the physical metals, because financial assets and stocks are going to get into serious trouble.
Steve, with that, you mentioned precious metals. Along with oil volatility, we did see some precious metals volatility going on with the Ukraine war. But with this energy cliff, what do you think this is going to do, not only to oil, but to another commodity such as precious metals?
In a nutshell, this is my message. It comes down to a simple term. The energy cliff is going to turn most assets into liabilities. And that's stocks, bonds, and real estate. Now, while you have to own a home, the value of that home is going to decline. Even if there's hyperinflation, hyperinflation does not last long. Because we have to remember homes, you need cars, driving from a home to go to work, and you need natural gas or electricity to heat and cool and run the home, and even all the commercial buildings. So the energy cliff is going to turn most financial assets into liabilities, and I call it, we are now transitioning from a time of building wealth, which was in stocks and bonds and real estate, to protecting it into gold and silver. There's other assets like diamonds as well, hard assets. But the reason why precious metals are a better store of value is because the energy that was used to extract and mill and refine that metal, if that energy value is locked in that coin. There's not energy in that coin. It's called energy value. It's like a bank of energy value. Unfortunately, a stock is based on earnings. And when earnings fall, when energy production falls, then you have lower earnings. And then I've mentioned this so many times, a 20 or 30-year treasury gets paid off if you have 20, 30 years of economic growth. Not just a plateau, but you have to have growth to be able to pay off that 30-year treasury. The same thing with a real estate, with a home. If you have a 20 or 30-year mortgage, you have to have 20, 30 years of economic activity to pay off that home. So all those assets get into serious trouble when we head over the energy cliff. And so I see the light bulb that's going to go off, Patrick. It's not really the small investor. They will, but it's the institutions, because institutions control 80% of the flow of funds in the markets, whether it's treasuries or whether it's real estate or whether it's stocks. So when they start moving into the precious metals, really the only place they can move into are the ETFs. And there just isn't that much available gold and silver for institutions or small investors to move into besides physical. And so that's the dynamic that's going to play out. It'll take a little time, but more and more institutions and investors are going to realize that.
Yeah, that's a great point there. But Steve, do you think at some point the metals price is going to have to bifurcate? I mean, we got this paper price and then we have a physical price, and the two aren't really, to me, it looks like they've already bifurcated. I mean, you can't get a physical piece of silver or gold for whatever the spot price is saying it's at. They're becoming further and further apart.
Well, when we're talking about retail bullion, you're right. The 1 ounce coins, the 10 ounce coins, the 100 ounce bars are a little bit more available, and you can still get the 1,000 ounce bars. But no, No one's going to walk into a store if times are tough and plop down a 1,000 ounce wholesale silver bar for a loaf of bread. It just doesn't work. And so the problem is the availability, the bottlenecks in producing enough of these coins. That's why I've said the real movement in the price of the metals, which has been the ETF flows. That's been the last 15 years. When we have big moves into the ETFs or movements out of the ETFs, that is when you see gold and silver move. Let me tell you, that's the wholesale bars. And we have to realize that the LBMA and CME have banned Russian gold and silver refineries. So that right now that's off the market. That just makes the situation even more interesting. But it's when the 1,000-ounce silver bar, if we're talking about silver, when we start to see a huge influx of the institutions moving into the ETFs, because really that's the only place they could go. They're not going to call up a dealer and ask for a 500 million in silver eagles. They can't. They're going to go on the ETF. And when JP Morgan or Sprott or whomever, ETF securities in Europe, when they can't access the silver, then you start seeing an explosive move in the price because the world is starting to realize there's not that much gold and silver. And there's way too much 400 trillion of overvalued financial assets and real estate. And that is the light bulb that is going to go off, especially as the energy cliff dynamics start to play out over the next several years.
But Steve, besides the energy cliff with the Russian-Ukraine conflict, the world has seen how countries can be cut off from the SWIFT system, which you just touched on earlier, at the behest of the U.S. and its allies. The U.S. dollar reserves can quickly become sort of useless if it cannot be accessed by the sanctioned country. Do you think the world will be more wary of their dependence on the dollar and the trend to de-dollarize and rely more on a neutral like gold, and gold will only increase from then on?
Boy, the system trades in dollars and other currencies because it's easier, right? Yeah, and so, but gold and to a much lesser extent, silver still act as a currency or a store of value. But no one is sending gold and silver back and forth for payments. We use the SWIFT system, or what's interesting, it's the CHIPS really that does the clearinghouse, the settlement of payment, which is the clearinghouse interbank payment system. Now, while Russia may have been banned from SWIFT, it's not banned from CHIPS. And CHIPS is the one that actually settles the dollar trade settlement. And so I think the issue is, as time goes on, the biggest problem is going to be the massive debt on the world's governments and corporate and private balance sheets, especially the United States. And again, I disagree that the money printing is causing inflation because I've said this before, a lot of this money supply that we're seeing coming into the United States on M2, that was borrowed from overseas. That did not come from the Fed printing the money. And then it was made into treasuries, because that's what the banks have to do. And then that was put on the Fed's balance sheet. So a lot of that M2 is gone. It's not on, it can't cause the inflation. What causes the inflation is the US government printing $1 trillion in treasuries to help fund the debt. That is inflationary. And so the world is realizing, well, I produce oil, but the United States consumes the oil and has a lot of fun going to Walt Disney World, Starbucks, and Walmart. But if it gets into trouble, it can add $1 trillion in debt, and some poor slob in the world is going to take that debt, which is a U.S. Treasury. And that is going to get very old, especially when the energy dynamics start to really cut into the economy. And that's when we're going to see more people, more institutions move into gold and silver and other commodities, because it's going to be owning those commodities, not the treasuries or not the euro treasuries, that are going to be able to provide the value for this kind of post-energy peak environment, which is going to be very disruptive. And so that's the best way for me to describe how I see it.
Okay, I mean, do you think, people are finally starting to wake up to the reality? When the poop really hits the fan, it's things like commodities, wheat, oil, grains, gold, silver, things like that, which are going to be king.
It only makes sense, right? Because as energy production gets into trouble, commercial real estate, why would you want to own a 100-floor commercial commercial building? You got to heat that darn thing. It's got all glass windows. It has no venting. You can't open a window, and you got to cool it during the winter. And all people are doing is like service. Service is going to get into serious trouble. I can tell you that. Service economies are going to get into serious trouble when energy production declines. And so, yes, a lot of the system is going to move away from the conventional assets, which are treasuries, bonds, and debt. And they're going to start moving into, or even stocks, they're going to start moving into real commodities or the companies that are producing those commodities. Now, I'm not saying that these stocks are going to go up 10 or 20 fold. They may do that. But if you own a company that's going to produce a good that has value, these are going to be, I think, where countries are going to start moving into more. And so, yes, I do agree with you. And again, we have to understand, the last thing I want to say, when energy production declines, the global supply chain is going to be very disruptive. What just happened? One of Europe's largest cyanide producers, which uses to make gold, use cyanide to extract the gold from the ore. They're going to cut production significantly because it's too expensive to produce the cyanide. So there's a whole bunch of things that are going to happen that we have no idea how it's going to impact the system until we get there. And so it's going to be very disruptive. That's why I'm a very big believer in just the owning the physical metals, because we could see mines in the future, even though they're producing gold, they may not be able to get the materials and the equipment and the parts to continue producing gold. That's something we need to realize.
Steve St Angelo, before we wrap up, can you let the viewers know where they can find you on the web and how they can follow you on social media?
Yeah, I've got the SRSRocco.com website where we put some free articles out, but we put a lot of paid content, and I do a lot of research. That's all I do is research to put out the changing details of what's happening. And that's really important because we need to understand how this is changing, especially the energy. So if you're a big precious metal investor, you have to force yourself to understand energy. It's because it's the most important reason to own the precious metals. So I spend a lot of time on Twitter, the SRSRocco Report Twitter feed. And I think it's very important for your subscribers to pay attention to the energy inventories, like you mentioned, the Strategic Petroleum Reserve. When these inventories, and I think Europe's in trouble if they're not able to build their natural gas inventories this year, before the winter hits, this next winter, they're going to be in serious trouble because they were able to bypass that this year. But next year, it's going to become more difficult. So that's the important thing, is to focus on the energy.
All right, Steve St Angelo, we appreciate the time, and more importantly, also we appreciate how you're giving us the info on these things that we absolutely need to know about, because it's really not being talked about on any financial news network. So we appreciate you sharing this with us. And I do look forward to speaking with you again soon.
Thank you.
That was Steve St Angelo sharing his views on energy, the economy, geopolitics, and precious metals. For more info on Steve, please visit his website, www.SRSRoccoReport.com. If you like this video, please give it a thumbs up, subscribe, and share to let the algos know you want to see more content like this. Audio-only versions of this interview can be found on iTunes and Spotify.